Hey everyone, welcome back to the channel. Big news today. The US inflation just dropped to its lowest in over 4 years, sparking massive buzz about the Federal Reserve slashing rates. So what's going on? Will your loans get cheaper, or is there a catch? Let's break it down. And stick around, because this could change everything for the US, the world, and even US China tensions. Hit that like button if you want the real scoop, and let's dive in. First up, the numbers. According to the U.S. Bureau of Labor Statistics, inflation in April 2025 fell to 2.3%, the lowest since February 2021. That's huge because it's basically at the Fed's 2% target. Now, rewind a bit. Back in 2022 and 2023, inflation soared past 9%, so the Fed jacked up rates to cool things down. Right now, the federal funds rate sits at 4.25% to 4.50%, per the Federal Reserve's own data. But late last year, in December 2024, they started easing up with a 25 basis point cut. And the Federal Open Market Committee projected rates could drop to 3.75% to 4% by the end of this year. So with inflation now at 2.3%, markets are betting on even faster cuts. But hold on, it's not that simple. Let's unpack why the Fed's thinking twice. So, why is the Fed considering a pivot? Well, a few big factors are at play. First, inflation being so close to 2% gives them room to lower rates, which could boost the economy. The US is showing signs of slowing down. Recent Federal Reserve statements even upgraded their language from uncertain to heightened uncertainty about the economy back in March. Plus, a cooling labor market might need a nudge to keep jobs growing. And let's not forget, financial markets are already pricing in cuts. Market data today shows bond yields jumping around like crazy, reflecting that hope. But here's the catch. The Fed's got some real worries. For one, President Trump's tariffs, reintroduced this year, could push prices back up. Economists warn that these tariffs might end this low inflation streak we're seeing. If the Fed cuts rates too soon and inflation spikes again, we could be back on that roller coaster. Another concern? Keeping rates high to fight potential inflation might slow the economy too much, risking a recession. And globally, things aren't looking great either. Recent global economic reports show a slowdown in Q1 2025, with weak demand and investment. If the Fed cuts rates, it could mess with emerging markets by strengthening the dollar. Oh, and let's not forget the political heat. Trump's been pushing for cuts, but Fed Chair Jerome Powell's holding firm on the Fed's independence. Tough spot, right? Now let's talk about what this means for the US. If the Fed does cut rates, borrowing gets cheaper. Think lower mortgage rates, car loans, you name it. That could give a big boost to sectors like housing and manufacturing, especially after this 2.3% inflation news. But here's the flip side. If tariffs drive up prices, as experts predict, cutting rates might fuel inflation again, hitting your wallet with higher costs. The labor market could see more hiring with lower rates, but if inflation spikes, your real wages might not keep up. And the markets? They're loving this news for now. But if the Fed doesn't meet expectations, we could see some serious volatility. Plus, the Fed's been reviewing its entire policy framework this year according to their own statements. A big change there could shake things up long-term, maybe even rethink that 2% inflation target. This doesn't just stop at the US, it's a global story. If the Fed cuts rates, the dollar usually weakens, which could help emerging markets with dollar debt. It might also boost global demand by increasing US imports, a win for places like China and the EU. But with a global slowdown already underway, Q1 2025 reports show declining demand. Those gains might be limited. Plus, a weaker dollar could raise commodity prices like oil, pushing up inflation worldwide. Now let's zoom in on U.S. China relations. Just last week, on May 12th, U.S. trade officials announced a 90-day trade truce with China, pausing tariffs and boosting markets. But if the Fed cuts rates and the dollar weakens, Chinese exports could get pricier, which might strain that truce. On the flip side, a weaker dollar could help China's push to make the yuan a global currency. Think petro-yuan deals in the Middle East. But if Fed cuts spark inflation and the dollar rebounds, that could hit China's plans hard. Economically, lower US rates might boost demand for Chinese goods, but if tariffs reignite inflation, trade tensions could flare up again. Geopolitically, if the US economy slows without cuts, Trump might blame China to shift focus, or if cuts work, he might get tougher on trade. Either way, it's a rocky road ahead. So, there you have it. The Fed's at a crossroads, and the stakes are high. Will they cut rates and save the day, or hold off and risk a slowdown? What do you think? Will rates drop soon? Drop your predictions in the comments below. and let's get the conversation going. If you found this breakdown helpful, smash that like button, hit subscribe, and ring the bell so you don't miss our next update. Stay sharp, and I'll catch you in the next video.